Welcome. In the world of accounting, government support can be a lifeline for businesses. But how do we record this in the books? Today, we're diving into IAS 20, the international standard for accounting for government grants and disclosure of government assistance. Whether it's a cash injection for new equipment or a subsidy for payroll, IAS 20 ensures these benefits are reported transparently and consistently. First, let's define our terms. A government grant is a transfer of resources to an entity in return for compliance with certain conditions. It's important to note what IAS 20 doesn't cover. It excludes government participation in ownership and tax-related benefits like investment tax credits or tax holidays. It also doesn't apply to grants covered by IAS 41, which deals with agriculture. Timing is everything. You cannot recognize a grant just because you applied for it. You need reasonable assurance of two things. 1. That the entity will comply with the conditions attached to the grant. 2. That the grant will actually be received. Remember, simply receiving the cash doesn't prove the conditions have been met. IAS 20 mandates the income approach. This means grants are recognized in profit or loss over the periods in which the entity recognizes the related costs. We don't just dump the whole grant into income the day we get it. We match it to the expenses it's meant to cover. If you receive a grant to buy an asset, like a new delivery truck, you have two presentation choices. Option 1. Deferred income. You record the grant as a liability and release it to income over the asset's useful life. Option 2. Netting. You deduct the grant from the cost of the asset. This results in lower depreciation charges over time. Both are acceptable, but you must be consistent. For grants related to income, like a salary subsidy, you also have two choices in the P&L. You can show the grant as other income or deduct it directly from the related expense. What if you fail to meet the conditions and have to pay the money back? This is treated as a change in accounting estimate. You first apply the repayment against any unamortized deferred credit. Any remaining balance is recognized immediately as an expense. Finally, disclosure is key. Stakeholders need to know your accounting policy and presentation methods, the nature and extent of the grants recognized, any unfulfilled conditions or contingencies. IAS 20 ensures that government assistance is not a hidden benefit. By following the income approach and providing clear disclosures, companies provide a true and fair view of their financial performance. Thanks for joining us for this breakdown of IAS 20, and don't forget to like and subscribe.